Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Sunday for Sunday, February 13th, 2022. We've got another great show for you this week. Members of the media, academia, and financial services are standing by to analyze all the news and events for the week. So sit back, relax, enjoy this episode of BRN Sunday. Let's kick off the show with a look at what's happening on Capitol Hill these days, and a lot going on. They're joining us from Washington, D.C. David Levine, Kevin Walsh, both are principals with Groom Law Group, and that's an employee benefits law firm based in good old Washington, D.C. And we finally refer to David and Kevin as the Legal Eagles after the not Mel Gibson, Robert Redford movie. Gentlemen, great to talk to you. Thanks so much for joining us on this Super Bowl Sunday.
Thanks, Jeff. It's always good to be on the program. And, we've got the Super Bowl coming up. We've got the Olympics going on. It's quite a time for athletics. And I think today, David's going to lead off talking about some regulatory gymnastics.
Ooh, yeah, okay. Wait. I thought today really was the day where we were going to talk about how you turn your Olympic medal or Super Bowl trophy into an NFT. Then you put it on a blockchain, and then you could sell shares in it.
David, even I've lost interest in the segment at this point.
But it's a retirement technique. I thought that was what we were talking about.
Yeah, at the end of the day, and in fact, I think we were all talking offline, and we made a pitch for the next. Forget NBC, we want to host the Olympics because we want to talk about what happens to these athletes after they compete and what happens to them as they save for retirement. Is it through endorsement deals? Is it through going into private business or public sector business, whatever? So we'll have to let you know when that goes. We're bidding on the. I don't even know where they are next year or in 2 years, but hopefully
they're in Paris in 24.
Oh mon Dieu! Anyway, David, let's get to the meat of the crux to the matter here. Let's talk about cyber security, and our friends at the Securities and Exchange Commission, not the SEC college conference, have weighed in.
Well, that's true. Well, maybe it is the college conference. I'm not sure, but let's dive on in. As listeners know, Kevin and I have had the privilege, or have at least appreciated the opportunity to speak to you about cybersecurity and what's gone on in that world. We obviously know breaches are a fact of life at this point and something that's happening relatively regularly. On the regulatory side, there is our never-ending tapestry of who's responsible for cybersecurity. You've got some state notification laws that may apply to vendors in certain areas, but we would argue oftentimes that, federal law should control this. Separate and distinct, we have the DOL, speaking of federal law, that has for about 2 years been asking questions. And the first it started off with 10 simple questions, and now the questions are 4 to 5 pages long and really detailed and require extreme IT knowledge at times to answer some of the more complex questions. And there's been a lot of discussion lately also as to the role of those questions, given some of the litigation like we talked about last week, because in some ways the DOL really hasn't actually issued cybersecurity guidance in a formal form. All they've done is sort of their website releases effectively in this process. So there's a lot of questions out there. Well, not to make it even a little more confusing, the SEC is now back in the game a little bit more. The SEC has put out additional guidance and regulatory package basically at this point that affects. I think the key focus here is registered investment advisors. Registered investment advisors about how they do reporting to the SEC, disclosing of certain events. I in my mind, I view it as very sort of principles-based. It doesn't have a extremely prescriptive, this is what your policy or this is what your approach types needs to be. But it results in more disclosure and more reporting, both to end-user clients. It sounded like a software license agreement, but
it does.
But back to.
Are you going to talk about EULAs next?
I am talking about EULAs, I guess, both to their clients, but also to the commission. Why does this matter? Well, when you have multiple regulatory regimens here that have to be followed, this is something that is out there now. And advisors need to think about this. And the real question for me that comes off of this is, historically you've had ERISA lawsuits, and sometimes you have separate securities lawsuits. Like the great example is like company stock drops, although those have died off a lot in recent years. We so often talk about the people who have the most data is your record keeper. But I think there's a real question coming as it relates to other people who touch data, because there's so much data flowing around the system about the, client information. And here, client is the plan, but it also could relate to participant level information in the plans as more and more people do that. What's your standards? How do you keep the data safe? And what if there is a breach? How is this all going to tie together in the plaintiffs? Because they like to bring two lawsuits. Could we see more advisor lawsuits? Could we see other intermediaries? I'd like to believe that the SEC standards, the way they're formulated, give a lot of room on this. But as you look forward, it certainly highlights that despite all the talk that it's always about the record keeper, everybody in the ecosystem really needs to think about it. So that's my takeaway. But it's good to just be aware they're out there. It's a relatively long release, so I'm not going to get into all the details of all the different form filings. But it just emphasizes disclosure, and process yet again.
Yeah,
Kevin?
well, go ahead,
I mean,
Kev.
David, I think you made great points about cybersecurity there, and I my preference usually when working with agencies is that they go through the type of rulemaking the SEC is doing as opposed to regulating in some other ways. So it's a pleasant change of pace from what we've seen elsewhere, that they're seeking input from the regulated community through a comment period. I mean, I wanted to pivot a little bit. The SEC has that, but they put out 3 rules, and I think 2 of them really relate to what we're the retirement space. They also issued a proposal this week that talks about private funds, and what it does is it essentially mandates additional reporting for private funds. It places restrictions on their ability to enter into separate agreements with individual investors as opposed to providing the same terms across the board. And it places some restrictions on the types of conflicts that they can clear themselves without seeking approval from the typical thing where you'd see an advisory committee for a private fund like a hedge fund or a private equity fund. And why it's relevant in our space is because in recent years there's been a lot of talk about whether the next iteration of target date funds as they continue to evolve are going to include an allocation to private asset classes. And the DOL weighed in last year and the year before that and highlighted some of the challenges in terms of transparency, understanding fees, and then ease of explaining what's going on to participants. And these new rules, they address a fair amount of the issues that DOL flagged. Now, there's pros and cons to this. One of the things that makes private funds so attractive is that they do have a reduced compliance cost. And, as an investor, if there's less money being spent on compliance, then, it essentially helps your return a little bit.
Yep.
On the other hand, if some of these go through, it will provide greater transparency for plan fiduciaries as they evaluate and monitor private funds for inclusion in target date funds. So I don't know if this package is a good thing or a bad thing. In some ways, it seems like it's a lot of work for just a little bit more transparency. It could be kind of disruptive to how private funds operate, and who knows what that would do. But on the other hand, if you look at what the DOL has been saying, it's worth monitoring this package just because, while you can put private funds in your target date fund today, some of the things that are highlighted in the SEC's proposal could make it easier for plan fiduciaries as they, weigh the pros and cons.
Well, let me just ask this gentleman. I mean, given what David just really covered, cybersecurity rulemaking from the SEC, or at least guidance from the SEC, and Kevin, what you talked about, which is private market disclosures, potentially reporting, it just sounds to me like it's just greater due diligence on the part of the fiduciary. So if you're thinking about who you're going to work with, maybe your own cybersecurity, but also the cybersecurity of your partners, that's your consultant advisor, as David said, around the ecosystem. And then also if you're considering adding alternative investments like private equity, real estate, hedge funds, you name it, that requires a lot of due diligence.
Yeah, it does. And whether you're looking at portfolio diversifying investments, or whether you're looking at a vendor, it's part of the process. It's an ever evolving process. And I think a key takeaway is, if you are a plan sponsor at this point, or a plan fiduciary at the plan sponsor, we know that we live in a world with a lot of outsourcing, a lot of turning to other parties for help. But when you select those parties, depending on the facts and circumstances, there's no one size fits all. There's probably some good things to check under the hood and look at to really understand what they're doing and how they're operating. And I think there's a lot to learn from there. But it doesn't mean that you can't do what you're doing. It's just the world keeps changing.
Yeah. All right, gentlemen, it's the eve of not the eve. It's a couple hours before Super Bowl Sunday. Do either of you have an opinion on the game? I think it's kind of cool, personally, that they're playing again in one of the team's home stadiums. But any thoughts, maybe from you, Kevin or David, on this year's Super Bowl? Don't hold back, gents.
Well, so I'll let David go first on this one if he wants to weigh in.
I have to admit, I do not have a strong view on the Super Bowl this year, but I know I have been hearing Kevin go on and on about this, so I'm going to let him talk about the Super Bowl.
All right, Kevin, lay it on us.
Yeah, so I'd like to see the Bengals win this. I have one of my law school roommates was from Cincinnati, and they have a rich tradition of having terrible professional sports teams. So this would be a real opportunity for them to get a win. LA, the weather, they've got a lot going on.
Kevin,
the Lakers.
Kevin, I want to apologize to everybody from Cincinnati. How dare you say you pick on them for their sports teams? We live in D.C. Our teams, especially in football, haven't been so great. So, watch about throwing those stones at glass houses.
I mean, the Nets won a World Series recently.
And the
LA,
Capitals won too.
You've got the Lakers.
Excuse me. I know we need to learn a little bit more about sports, but we're talking football today, Kevin.
Yeah, Dave, we're talking sports ball today. I mean, come on. But no, so
Fair enough.
I'd like to see Cincinnati win. The Rams have a good team, and they've got a young coach, and I think they'll be back. Cincinnati with Joe Burrow, they've also got a young quarterback, but it's a long-suffering sports town, unlike DC, where we had those big Caps and Nats wins that David chooses to gloss over.
Yeah, well, it's going to be.
Hey.
Oh, well, I think it's going to be an interesting. I'm looking forward to the commercials as always, and then the halftime show. And I'm an AFC North. The Baltimore Ravens are in the AFC North, so I have to go support the North. But I think it's going to be a fun game. But leave it there, gentlemen. David Levine, Kevin Walsh, great talking with you. Enjoy the rest of your weekend, and we'll talk to you again very soon.
Thanks, Jeff, and thanks, listeners.
Bye, guys. Welcome back. Now we're going to shift gears, talk a little tech, streaming, consumer products, you name it. We cover it in this segment. Joining us on the line, he is the managing editor of The Street. We're talking about Daniel Klein. Dan, thanks so much for joining us on the program this morning.
Good morning from the Odyssey of the Seas, somewhere in the Bahamas, Jeff.
Well, I hope the weather is beautiful. Yeah, we had some nice weather here later in the week in Charlotte. It's in close to 70, so hopefully the rest of the country, or at least the rest of the Northeast, is getting that, and we're getting onward to spring. Dan, let's talk about we got a plethora of stories this week, and I think it kind of dives into a lot of different segments of the marketplace. Let's start off with talking about Peloton. They made a lot of news this past week with cutting 20% of their workforce, about 2,800 employees, and rumors that we've talked about with you about selling themselves to another company. What say you?
Yeah, so Peloton's in trouble, and it was always a challenge. So the problem Peloton had was, and every manufacturing company has this, is during the height of the pandemic, demand for Pelotons was very high. Mm-hmm. So they made investments and increased capacity. The conundrum is you either do that and get all the sales, but then have excess capacity that you may not need in the next few years, or you don't do that and you miss out on some of the sales. Now, in some industries, people might wait a year, but people weren't likely to wait a year for a Peloton when they could buy a Nordic track or somebody else's bike or, whatever. Go buy any exercise bike and staple an iPad to it, and voila, you have a Peloton. And I'm teasing a little bit, but you could take Peloton classes not with a Peloton. I know some features don't work, but Peloton basically outbuilt its demand. And now that we've had, people will say it's because people are going back to gyms. I would just all the people who can afford and want a Peloton, most of them got one. And now it's going to take a year or two until there's sort of new demand for this product. And that put them in a position where their stock crashed. And look, I always thought Peloton made a lot of sense for Apple and maybe some sense for Amazon. And now both of those companies are in the rumored mix to acquire them. And, Peloton would still be Apple's most expensive acquisition. But, if their market cap's $9 billion now or $10 billion, I don't remember the exact number, and Apple buys them at a 20% premium, that's not an insane number based on what they paid for Beats or, some of the other purchases. And, Apple Fitness Plus and Peloton match really nicely.
Yeah. Dan, what's the timeline on this? They just brought in on this potential move, they brought in a new CEO. They replaced the old CEO who becomes executive chairman. I think they got the CFO of Netflix, if I'm not mistaken, to be the CEO of Peloton to kind of handle things. But what's the expected time frame for a potential sale?
So it doesn't seem like they're intending a sale to happen, but they're also not saying no at the right price. Because here's the reality. Peloton has a viable business. You look at their subscription base, you look at their hardware sales. This has never been a hardware company. Just like Apple, you don't make a lot of money selling a Mac or an iPhone. You make a lot of money in the store after the fact with all the subscriptions they sell now. So the reality is Peloton is in a pretty good position that while its market cap is bad, its stock has suffered, its actual underlying business, which is losing money, it should very likely move to cash positive at some point next year. So this isn't a company that needs to sell, meaning that if Apple or Amazon wants to buy them, they're probably going to have to pay higher than that 20% premium I just said. So as bad as things are for Peloton, they're not in a terrible position.
Yeah. Dan, let's talk streaming. I know you're in the Bahamas, but you're a big fan of Disney and Disney Plus, and I think the potential is that Disney Plus may raise their prices. And we've seen this, by the way, with Netflix and some of the other streaming services. First, does it surprise you? Two, what's the impact?
So it doesn't surprise me because Disney Plus always had like a weird low price point. And the reality is the pandemic delayed their ability to significantly raise prices because they couldn't produce shows at the speed you would want to produce shows in order to charge people more money. But I just wrote an article on this. I don't even know if it's live yet, so I won't promote it. But Bob Chapek came out and said, we're putting all of these new movies, all of these shows, all this Disney, Marvel, Star Wars content on Disney Plus. And in 2023, he was very unclear whether that meant fiscal or actual 2023, we're going to raise prices. And he said, he called it a value proposition. And this has been a Disney model. Disney essentially, after the pandemic, raised the prices of all its annual passes at Disney World. It also increased the prices of, a churro costs more, or you might pay the same for your chicken nuggets, but you get 4 instead of 6. Disney has always been really willing to raise prices, and their excuse for it has always been, we're giving you more. And that's kind of what they're doing with Disney Plus. But I don't see any impact because if you're paying whatever it is, $14.99 for Netflix, does it matter to you if you pay $7.99 or $9.99 for Disney Plus? I know that I can't wait to get home and watch the finale of Book of Boba Fett, and I'm super excited for Obi-Wan. Are you telling me that watching, 7 episodes of Book of Boba Fett, I wouldn't pay a movie for each one? I probably would. I probably would have paid $9.99 an episode.
Yeah, I just wonder, and I agree with you on that. I mean, $9.99 relative to some of these other platforms like Hulu and Sling, which are different in terms of content. These are like streaming television services that you get over the internet. But I just wonder if there is a capacity by which, like we've seen with Netflix, that you cap off the number of subscribers. People who have Netflix already have people who want Netflix already have it, unless you're coming out of the womb today, in which case you won't be able to buy anything for 18 years. Where's the opportunity for some of these streaming services to get more subscribers? Is it abroad? And by abroad, I mean in some of these emerging markets?
Yeah, well, I mean, there's a huge global opportunity. Disney's only in a relative handful of countries compared to Netflix. Disney also has lower costs. It's a lot easier to take, Pinocchio and globalize it than it is to take Stranger Things. And sure, you could put it in another language, but it's a very American show. A lot of Netflix, whereas a lot of Disney's content is pretty universal for children. Star Wars translates really well around the world. Marvel does, the superheroes are pretty American, but overall story translates really well. So yeah, the reality is there's a huge global growth, and there's also, I don't want to call it the slow demise of cable because we've seen cable shrink and shrink and shrink, but as we go forward, the 80-something million Americans that pay for either a traditional cable or a streaming cable via Hulu Live or YouTube or Sling or whatever it is, more of those people are going to say, you know what, I can get everything I want with very specific subscriptions. Maybe I don't need full cable. I just want to be able to watch Boston Celtics games, and I'll get NBA League Pass. At that point, if you're watching Disney Plus 2 or 3 shows a week you look forward to, are you going to care if it costs $24.99 a month? I don't think you will, as long as it builds to that and it becomes an essential part of your life. If you free up that, $140 to $200 or whatever it is you're paying for cable, almost anything else seems reasonable until the numbers get really, really high. And who's going to suffer? Your Peacocks of the world, your second-tier players. I think there's going to be a nice little niche for Discovery Plus at a low price point where you just get a bunch of cooking and home content. But I do think if you're not Netflix or Disney, and people always get mad at me for leaving out Amazon Prime, but nobody buys Amazon Prime for the video. They buy it for the free shipping, and the video is an add-on. I think your HBOs of the world are going to struggle when cable stops being a thing and you're not reflexively just buying HBO because – I'm watching Peacemaker right now, but the reality is there's just not a lot of shows I want to watch on that show. So this will be a winner's win, and the losers are either going to get really smart in the niche, or maybe you'll see some bundled services where you pay $9.99 a month, and you get X amount of hours on Paramount Plus, Peacock, all these second-tier services. I think it's going to get very interesting over the next few years.
All right, Dan, let's talk about sorry, my phone was going off. Let's talk about phone contracts. I feel like we talked about buying an exercise bike. We talked about streaming. Let's talk about Verizon extending out its contracts now from 24 and 30 months. I think we're all familiar with if you have Verizon. By the way, most carriers 24 to 36 months. This is going to be 36 months for all devices, hotspots, and smartwatches. What's the beef here?
Well, it's really interesting because basically the old model was you paid a contract and sort of got your device and it was sort of rolled into it, but you never really learned what you're paying for your device. Now, the price is the price for your service and you sign a contract on your device. So instead of giving them $1,100 up front for an iPhone, you pay X amount per month. And the vast majority of those contracts across like T-Mobile and AT&T have been 12 or 24 months, meaning you either pay a pretty big chunk a month or you extend it out a little longer. What Verizon is doing is they're saying all contracts for devices will be 36 months, and that lowers your payment. So it's a strategic move, but it could hurt Apple a little bit because it might have the average person say, you know what, I don't own this device yet. I'm not going to trade it in and have to pay it off in order to buy the new one. And the average replacement cycle is about 2 years because people tend to get off contract and then immediately get a new device. This might take that 100 million plus Verizon customers and have at least some percentage of them say, you know what, I'm going to hold on to my iPhone for one more year. I do think it matters because, Jeff, I'm talking to you on an iPhone 13, and I don't think I could tell you what was different about it from my iPhone 10. And I think that is a real problem for Apple going forward.
Well, my wife and I were just talking. We have iPhone 10s, which we bought in November of 2016, Dan. So, we look at what comes out, and we think about whether or not now you're in the business of reviewing technology. So that I think you're a unique in that respect. But for me as a consumer, I didn't notice many differences between 10 and 11, 11 to 12, 12 to 13. Now I am interested in the SE that's going to come out because I've heard that it could be 5G.
Yeah, I mean, 5G was a big leap for me, and that did matter. The reality is, Jeff, like I tell my wife that's why I get the new iPhone, but the reality is I'm a dummy. Like there's no reason to upgrade most of the time. And I'll tell you now that I'm not going to get the 14, but I'd be lying. Like, I'm absolutely going to get the 14. And I'm always going to have a big phone payment. Now, I would argue that I make good money. I'm not a particularly indulgent person. We don't live in a large house for our means. I drive a 2014 Toyota Prius. And if having the latest iPhone is what makes me happy, I'm in position to do that. But the reality is, if I was paying for this on contract with Verizon, and I was, more of a normal person and less of a gadget head, I might think, and maybe if I was someone who bought a new one every year because I was halfway through my contract, maybe if I'm only a third of the way through, I wait another year. Maybe if I'm someone who waits the full 2 years, maybe now I wait the 3. Do I think it's a material drop to Apple? No, but I think if this becomes the norm, it could either force Apple to innovate, or it could just slow iPhone sales. And look, Apple's done a wonderful job. iPhone sales at points used to be 70% of their total, and they've really grown service revenues and other things, and it's no longer like that, but it's still Apple's most important product by a lot.
All right, Dan, I can't let you go on Super Bowl Sunday without asking your thought about the Super Bowl. We've got the Cincinnati Bengals, the Los Angeles Rams. Who's your pick this? I know you're a Patriots fan. I believe you're a Patriots fan and a Celtics fan and a Red Sox fan. But who's your pick? Who's your pick this year?
Yeah, I think it's a Rams blowout.
Okay.
I feel bad for the people of Cincinnati, but they got their little thrill, and I look forward to 30 years from now when they have another run in the playoffs. No, I'm teasing a little bit. Cincinnati, Joe Burrow, they look, like they'll be a wild card loser for the next decade. But this was a magical run, and I just think that there's too much firepower in Los Angeles. And that being said, I'll be watching the game, but largely for the commercials. I don't know. I have a hard time caring when there's no real storyline that involves my team, or even had the 49ers made it, there would have been a little expatriate factor in Jimmy Garoppolo like there was last year with Brady in Tampa Bay. So having been away for a week, I'm not entirely sure I'm going to tell my wife, hey, I'm watching the Super Bowl for 5 hours on Sunday.
Well, Dan, have a safe rest of your trip. Be safe getting back, and we'll talk to you again next week, my friend.
I'll see you next week, Jeff. Thanks.
Bye. Welcome back. Now we're going to close out the show with a look at what's happening in travel and real estate, and there's no better person I can think of to do that than Jacob Passy, who wears multiple hats. I'm not even going to define him as a real estate journalist or a travel journalist. He's just a journalist with Market Watch. Jacob, thanks so much for joining us on the program this morning.
Glad to be here.
Okay, so let's before we get to real estate, let's talk about travel, because a lot's changed. Obviously, we've been dealing with the Omicron variant, the COVID variant, or the COVID for the better part of 2 years. Have there been some developments in travel this past week?
Yeah. So, I think where we're at right now in terms of, looking at a very broad, take on the industry is things are getting, closer to normal in the travel industry, especially after, a lot of folks who were traveling over the Christmas and New Year's holidays probably experienced, delays or cancellations, and those, carried into the beginning of January because of Omicron as airline staffs all, a lot of airline flight attendants, pilots, baggage handlers, et cetera, got sick because of Omicron, because of how easy it was to catch. And so that the airlines are still dealing with staffing shortages and issues like that. And, because of that, we saw a lot of, when some of the airline employees were having to call out sick, the airlines didn't have, the bandwidth to, maintain all those flights. And we saw high numbers of cancellations well into 2021. Now things are a bit more back to normal, but we're still seeing some of the fallout from that. So, for instance, this week, probably the biggest news in travel was the announcement that Frontier Airlines and Spirit Airlines, two of the super low budget airlines carriers, are merging. They're going to form one company. Not yet clear whether they're going to merge their airlines or just have one company operating both airlines. But either way, they're merging. And what's really interesting about that was one of the biggest points they made in justifying the merger was they were saying, they as low-cost carriers have a hard time competing with the big hitters, with the Deltas, United, American Airlines. They have trouble competing with them for staff, and they sort of say that, like, I think an analyst compared the low-budget airlines to farm teams. Their pilots get coached by Delta and other, larger players in the industry. And, that creates a real challenge for these budget carriers because they still have to, staff up. So I thought that was interesting in light of what we saw with Omicron and how that caused so many headaches for the airline industry. I think a big story moving forward in travel, and this also extends to cruise lines have their staffing challenges. I know hotels are still, reducing services, not necessarily doing daily housekeeping, in some cases not offering the full continental breakfast because, all across the travel industry, they had to cut so many of their staff during the height of the pandemic to save money and reduce their costs. But now we're in a position where, demand has bounced back. People want to travel and are traveling in droves, but we don't have the employees at these companies to handle that, and that's causing some headaches.
Yeah, and that, Jacob, I mean, that you look across multiple, not just travel industry, and hospitality, many industries struggling to find workers of all types at all levels. What about the impact of the weather, Jacob? And we had numerous cancellations here in the Northeast. They must have had 2 feet of snow or more in the Boston, Massachusetts area, Rhode Island, New Hampshire. That's also got to play havoc on top of the Omicron variant and the worker shortage.
Oh, you're totally right. I should. You're right to point that out because that was the other factor during the Christmas holidays. There was bad weather all across the country, so it was like kind of a double hitter, and that was what really created problems for airlines. You're totally right that weather does play a huge factor, and the reason for that is the way that airline staff and position their planes throughout the country. Different airlines take different approaches, and so that's why you might see some airlines be more adversely affected than others by bad weather. Some airlines like Southwest is a good example of this. Rather than having one plane that just serves the same route back and forth, or like the same handful of routes, in a pattern, their planes kind of hopscotch all around the country. So, if a flight that originates in Boston was then meant to go to Miami, then to Dallas, then so on and so forth, down the chain, you'll see cancellations if there's bad weather in one part of the country. Other airlines, sometimes run more of a hub and spoke type model where many of their flights are coming out of the hub or just going back and forth between destinations. And so in those cases, those airlines may have less of an adverse impact from bad weather or staffing challenges in one part of the country because it's only going to affect those specific flights and not have this sort of ripple effect throughout the rest of their itineraries. Weather is definitely a huge issue. Basically anything that creates challenging situations with staffing is that the airlines can't staff fast enough for pilots, for flight attendants. There's a number of reasons for that. A lot of pilots took early retirement packages and things like that. Same with flight attendants during the pandemic. And it's not so easy just to bring them back because there's all the regulations in terms of the number of hours they have to train and fly to keep their license. And so I have a friend who's a pilot, and he works for one of the major airlines. And I remember during the height of the pandemic, and that's why you saw during the height of the pandemic, sometimes airlines were flying basically empty flights because he needed to keep his hours so that he could continue to fly. So he sometimes was flying planes with only a few people in them. So I think that this is going to be the ongoing situation. If you're planning a trip in the future, one thing to keep in mind that I learned from travel experts is these staffing challenges are more likely to be worse at the end of a month than at the beginning of the month because regulations, federal regulations, dictate how many hours per month flight attendants and pilots can work. So that's why we see problems often arise at the end of the month if there's bad weather or if another COVID variant, I guess, crops up, because there's less bandwidth in the airline staffing. They can't just replace willy-nilly one pilot with another, because the replacement pilot may have worked too many hours that month to be able to fly again. So it's challenging. It's really challenging for the airlines right now.
It is, and let's not forget the price of fuel, which is, I'm sure, gone up significantly. Let's kind of pivot a little bit. Inflation, the Federal Reserve is meeting. They're going to potentially raise interest rates. We don't know what that number is. I guess we'll have to. It's like kind of like a shell. It's almost like a wait and see type of game. But how does the current interest rate environment impact or doesn't impact real estate? Because that's one of your other beats. I mean, you're like the three-headed monster in that you can cover travel, you can cover personal finance, and I want to segue now to real estate. How does this impact, or what are you hearing or seeing on the mortgage rate front?
Totally. So mortgage rates this past week jumped even higher. They are now at the level last seen in January 2020. So basically, mortgage rates are back where they were before the pandemic, which is, from a historical perspective, not that high. I don't want to, act like they're, through the roof or anything like that. If you bought a home in the 80s, you certainly saw a much higher interest rate. But the difference between the 80s and today is home prices are much higher today and rising still at a very fast clip, even if it's at a slower pace than it was perhaps a year ago. So mortgage rates are still rising, are expected to continue to rise throughout the rest of the year. In terms of the Federal Reserve's moves, those have largely been baked into the interest rates we're seeing in the mortgage market, because mortgage rates are long-term interest rates. The Federal Reserve controls short-term interest rates. So investors guide kind of the activity of mortgage rates because of how they buy or sell bonds. So as bond yields rise, mortgage rates kind of rise in tandem for long-term bonds, that is, like your 10-year Treasury notes, things like that. So those have been the yields on those have been rising, so therefore mortgage rates have been rising. But it is creating a huge affordability challenge now. In the past week, we saw a pretty significant drop-off in the number of mortgage applications, which is kind of a gauge of how many people are in the market to buy a home. For a while, we had seen that rising, in part because people still, the reasons for the demand are still out there in terms of folks getting married, having kids, needing more space, things like that. But there was this kind of surge at the beginning of the year, very start of the year, where we were seeing kind of an unseasonal interest in home buying, because some economists said because people were trying to get ahead of what they expected in terms of a mortgage rate increase. So we probably have seen in recent weeks a large number of people trying to buy homes to, lock in a lower mortgage rate in anticipation of what's already kind of happened with mortgage rates rising. Fannie Mae put out a report this week. They do a monthly report on the sentiment among Americans when it comes to buying or selling a home. And only 25% of buyers said, or rather of Americans, said now was a good time to buy a home, which is a record low since they've been tracking that data. So it just shows, and mortgage rates are just one part of that. Rising home prices, obviously another factor, but the two combined to make an especially challenging market for buyers. And I think, while this next year we're still going to see probably pretty strong demand for home buying, we're going to see a lot of people priced out of the market. And also just the number of homes for sale has not budged. It still is near record lows. So that's going to naturally keep kind of a ceiling on things in terms of how many homes can be sold.
It really is interesting, candidly, to watch how this market unfolds. And context is always important, Jacob. And look, I lived in the 70s and 80s where they had very high interest rates. These are higher interest rates, but historically not very high interest rates. All right, Jacob, I've been asking every guest on this show and I'm going to put the question to you. What are you doing for the Super Bowl? Because it's in a few hours. The show airs on Sunday. What are you all doing for the Super Bowl? Are you going to be cooking? And are you rooting for anyone in particular?
So I know that the two teams that are playing are from Los Angeles and Cleveland, and that's about the extent of my knowledge of the sports end of things. I've been devouring the Olympics content, so if you ask me, it's a real shame that the Super Bowl has to happen when the Olympics are happening. But I digress. We'll probably eat. We're probably going to make some like finger foods. That's what we usually do, like pigs in a blanket or something like that. And I mean, we're the classic household, my husband and I, who like to watch the Super Bowl for the commercials and fast forward through the game. So we'll be paying attention to those. I also think, like, as a reporter, kind of always interesting to see which companies are advertising and what that kind of says about the state of things. So I know that there's going to be a bunch of ads for travel booking websites. So going back to our earlier discussion of travel demand, I think that's a pretty strong indication of things if travel companies are willing to spend money on a Super Bowl ad, given how expensive those are. So looking forward to some fun ads and finger food.
Yeah, it's going to be interesting, and I think I'm right there with you. I like the commercials. I like watching the halftime show. But I'm really not into the game itself, so we'll see. Maybe we'll talk about it next week, and you'll give us an update on. You're probably writing an article about this, so maybe we'll cover it. Not to tell you what to do, but as on what the spend looks like for travel companies, and I think you're probably right about that because they're looking to attract buyers. Jacob, we're going to have to leave it there. Enjoy the rest of your weekend. Have fun at the game. Enjoy those pigs in the blanket, and we'll talk to you again very soon.
Talk next week. Take care.
Bye-bye. And that wraps up this episode of BRN Sunday. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the latest in lifestyle, wellness, finance, tech, so much more, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives and see our latest content? Check out our website, www.broadcastretirementnetwork.com, and our streaming partners like Roku, Amazon, Samsung, and over 100 more. We're back again tomorrow for BRN AM. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.